Every generation believes it has finally figured money out. Not just improved it, not adjusted it, not made it slightly safer. Figured it out. They say it with confidence, with charts, with new language, with fresh theories that promise to tame risk, smooth cycles, and turn uncertainty into something manageable, something scientific, something civilized. And every time, history waits. Because behind the new tools, the smarter models, the faster markets, there's one constant that never changes: human behavior. And human behavior is remarkably loyal to its illusions. Economic crashes repeat, modern financial systems fail, and the pattern continues despite our confidence. This time is different. Those four words have preceded more financial disasters than bad math ever did. They've been spoken by merchants in 17th century Amsterdam, bankers in 1920s New York, traders in late 1990s Silicon Valley, and policymakers with far more degrees than humility. Each time, the conviction was sincere. Each time, the outcome was familiar. Economic crashes repeat because we forget. Modern financial systems collapse because sophistication doesn't equal safety. And despite all our advances, the same illusions keep winning. Welcome to HistoMoney, where money, power, and history collide, and nothing is ever as simple as it looks. This isn't a story about a single crash, a single bubble, or a single mistake. It's about something deeper, something quieter. The reason the same economic illusions keep resurfacing century after century, even as societies grow richer, smarter, and more technologically advanced. If markets were purely rational, economic history would be boring, linear, predictable. But markets are not machines. They are mirrors. They reflect fear, optimism, greed, denial, and hope, often all at once. And when enough people believe the same comforting story, illusion hardens into consensus. Take a step back and look at the long arc, not the details, the pattern. In the 1630s, Dutch traders convinced themselves that tulip bulbs had transcended agriculture and become a new asset class. Prices detached from utility. Logic followed price, and anyone questioning it simply didn't understand the market. 3 centuries later, investors said the same thing about radio stocks in the 1920s, then about conglomerates in the 1960s, then dot-coms in the 1990s, then housing in the early 2000s. Different centuries, different assets, identical logic. What changed wasn't the illusion, it was the costume. Each era wraps its optimism in the most advanced language available. In one century, it's trade routes and empire. In another, it's industrial productivity. Later, it's financial engineering. Today, it's algorithms, liquidity, and new paradigms. The sophistication grows. The vulnerability remains. Because illusions don't survive by being obviously false. They survive by being emotionally useful. One of the oldest illusions humans fall for is the belief in permanent growth, the idea that progress, once achieved, becomes a law of nature, that tomorrow will always be larger than today, not because of effort or discipline, but because that's simply how the system works now. Empires believed it, corporations believed it, governments believed it, households still do. Growth becomes less a result and more a promise, and once growth is assumed, anything that threatens it feels temporary, abnormal, or fixable with the right lever. Slowdowns are framed as glitches, corrections as overreactions, structural limits as outdated thinking, until one decision changes everything. When growth falters, societies rarely question the belief itself, they question the obstacle. So systems stretch, credit expands, rules loosen, risk is pushed forward in time, pain is deferred, not eliminated. The illusion survives, at least a little longer. And this is where illusion deepens into structure. As financial systems grow more complex, another belief quietly takes hold, that complexity equals safety, that slicing risk, modeling it, insuring it, and dispersing it somehow makes it disappear. In reality, complexity doesn't remove risk, it redistributes it, it obscures it, it delays its visibility. When no one fully understands the system anymore, fear fades, and when fear fades, caution goes with it. If complexity prevented disaster, the most sophisticated financial systems in history wouldn't keep failing so publicly. But complexity serves a different function. It creates distance between cause and consequence. It allows responsibility to dissolve into process. It makes failure feel technical instead of human. And most importantly, it creates the illusion that someone, somewhere, is in control. That belief is one of the most powerful economic sedatives ever invented. Central banks, regulators, institutions, experts. Societies place enormous psychological weight on the idea that there's a cockpit and someone competent is sitting in it. Not because it's always true, but because believing it keeps the system moving. Confidence, after all, is a form of currency, yet history shows that control is often reactive, fragmented, and constrained by incentives that rarely align with long-term stability. Decisions are made under pressure, with incomplete information and with political consequences hovering over every move. The appearance of control buys time, it does not guarantee outcomes. Meanwhile, the costs don't vanish, they shift. Debt allows societies to consume future growth today. Inflation allows governments to reduce obligations quietly. Bailouts allow losses to be absorbed by systems rather than individuals. Or at least that's how it's sold. Each mechanism feeds another illusion that pain can be managed without being paid, that consequences can be postponed indefinitely, that someone else will absorb the impact. But history is relentless about one thing. Costs always surface, and when they do, they rarely land evenly. Some gain early, some exit in time, some never recover at all. Entire generations can do everything right and still inherit a system burdened by decisions they never voted for. That's not a moral failure, it's a structural one, born from illusions that outlived their usefulness. The most dangerous moment in any economic cycle isn't collapse, it's confidence. The moment when people believe the system has evolved beyond its own history, that risk has been mastered, that warnings are outdated, that skeptics simply don't get it. History doesn't repeat because it wants to, it repeats because human psychology hasn't evolved at the same speed as financial systems. And in that gap between innovation and behavior, illusions thrive. And the longer they go unchallenged, the more convincing they become, until they aren't. What makes these illusions so resilient isn't ignorance, it's familiarity. By the time a system begins to show stress, most people living inside it have never experienced anything else. The rules feel natural, the incentives feel permanent, the structure feels inevitable. Questioning it sounds less like wisdom and more like heresy. And so each generation learns the wrong lesson from the last crisis. After collapse, societies promise restraint. They build safeguards, they write regulations thick enough to reassure themselves that the damage won't repeat. But memory fades faster than structures decay. Over time, the safeguards are reframed as obstacles, the rules become inefficient, the caution feels excessive. What was once protection slowly becomes friction. Meanwhile, new actors enter the system. They didn't live through the previous failure, they didn't feel the fear. They inherit the rewards, not the scars. To them, the warnings sound abstract, like myths from a less advanced age. And that's how illusion quietly regains ground. This is why economic cycles don't require collective stupidity, they require collective amnesia. The human mind is not built to hold long, abstract timelines of risk. It responds to what is visible, immediate, and reinforced. When systems reward certain behaviors for long enough, those behaviors begin to feel rational, even when they're fragile. The modern world hasn't escaped this dynamic, it's accelerated it. Information travels faster than ever, markets react in milliseconds, capital moves across borders at the click of a button. Yet decision-making is still filtered through the same emotional machinery that once guided merchants loading ships by candlelight. The tools are sharper, the instincts are the same. Short-term success is still mistaken for proof. Rising prices are still confused with value. Complexity is still treated as intelligence. And when something works long enough, people stop asking why it works and start assuming it always will. That's the quiet danger of sophistication. It can anesthetize skepticism. One of the most persistent illusions of modern finance is the belief that knowledge alone protects us, that because we have more data, more models, more history books, we must be less vulnerable. But information doesn't automatically produce wisdom. In many cases, it produces confidence, and confidence, unchecked, can be just as dangerous as ignorance. Economic systems don't collapse because everyone misunderstands them. They collapse because enough people understand them just enough to exploit incentives while assuming someone else is managing the downside. The truth is uncomfortable but simple. No system can outgrow the psychology of the people operating it. Markets don't fail because charts were wrong. They fail because humans consistently overestimate their ability to control outcomes, underestimate tail risks, and delay accountability when the cost isn't immediate. And when consequences finally arrive, they're often framed as anomalies, external shocks, unforeseeable events, anything but the result of patterns that were visible all along. This is where history stops being academic and starts being practical. Because the real lesson isn't about predicting the next crisis. That instinct, the urge to forecast collapse, is just another illusion wearing the mask of preparedness. History is far less useful as a crystal ball than it is as a mirror. What it shows us again and again is how easily humans trade long-term resilience for short-term comfort, how quickly caution erodes once stability feels normal. How systems built to manage risk gradually become systems designed to postpone it, and how those postponements always come with a price. Financial freedom doesn't come from timing markets or outsmarting cycles. It comes from understanding where illusions live and refusing to build your life entirely inside them. It comes from recognizing that systems are shaped by incentives, not intentions, that policies are constrained by politics, that complexity often hides fragility rather than eliminating it. Most importantly, it comes from humility, the kind that accepts that no era is immune, no structure permanent, and no amount of intelligence sufficient to override human nature. History doesn't punish ignorance immediately. It waits. It lets confidence rebuild. It allows new stories to form, and only then does it collect its due. The people who suffer most aren't the ones who never believed the illusion. They're the ones who believed it had finally disappeared. As this year closes, that may be the most valuable lesson of all. Not fear, not pessimism, just clarity. The understanding that progress doesn't erase patterns, it disguises them. And that the past isn't behind us, it's beneath us, quietly shaping the ground we stand on. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.